Welcome, everyone. My name is Tim Healy, and I work for SunPath Financial as a retirement specialist whose mission is to educate and guide clients on how to build and protect their retirement income through strategic planning. SunPath Financial is located here in Newport Beach, California, and was started with the premise of putting the client's needs first. Our unique position grants us access to nearly all large banks, insurance companies, and brokerage firms. In other words, we're not limited to a single company's offerings, allowing us to fulfill the role of a true advisor. Some of the things that we offer our clients are Social Security benefit planning and maximization, retirement income solutions, retirement tax reduction, long-term care solutions, 401k, and IRA rollovers. Now, as you may know, one of the key components when planning for retirement is Social Security. And today, I can promise you will walk away with a good understanding of it. The presentation will run about 25 to 30 minutes. And again, thank you all for joining, and let's get started. Social Security benefits represent a critical part of total retirement income for most Americans. And although many of us are concerned about the long-term care of the system, we're going to set that aside for today's discussion. Let's put the importance of Social Security into perspective by examining its lifetime value. If your monthly benefit was $2,000, in 10 years, you'd collect $256,000. Most people collect benefits longer than 10 years. 15 years, $400,000. 20 years, and your total benefits would exceed $554,000. And lastly, 25 years, which is not unusual, and you would have collected more than $721,000. These figures assume an annual cost of living allowance referred to as COLA of 1.5% per year. We'll discuss COLA later in the presentation, but for now, I think we can agree that Social Security income is important. Today in our presentation, we're going to cover the basics, spousal benefits, the work penalty, how to determine your benefits, taxation, and finally, we'll bring it all together. Now let's jump in and begin with the basics. The basic function of Social Security is simple. Every working person pays into the system, and at retirement, they receive a lifetime income. Workers who have paid into the system and their eligible spouses can receive a retirement benefit in the first full month of attained age 62. Keep in mind that you'll need to apply 3 months prior to your desired starting date. Your retirement benefits are determined by your earnings record, average index wages in the year you turn 60, and other mathematical factors to determine your primary insurance amount. Your primary insurance amount is your monthly benefit at your normal retirement age. Normal retirement age depends upon the year in which you were born. For those born between 1943 and 1954, it's age 66. For those born after 1954, it's extended beyond the age 66 from 2 to 10 months. These are the adjustments to Social Security made by Congress because people are living longer. So, your primary insurance amount is the benefit you receive at normal retirement age, but your actual benefit may be lower or higher depending upon when you elect to begin benefits. Let's look at the basic difference in benefits over time. Assume you have a primary insurance amount of $2,000 per month at normal retirement age of 66. If you elect to start your benefits at age 62, you will receive 75% of that amount, or $1,500 per month. At 66, your benefits will be $2,000 monthly. At age 70, you'll collect $2,640 because Social Security benefits increase 8% per year after age 66 with a max of 132%. But the difference in early or maximum benefits is also dependent upon your normal retirement age, which is dependent upon the year you were born. As we see here, for those born between 1943 and 1954, normal retirement age is 66. So the early benefit equals 75% of the primary insurance amount, and the maximum benefit is 132% of the primary insurance amount. But this is different for other years of birth. For those born in 1955, normal retirement age is 66 and 2 months. In this case, early benefits at age 62 are only 74.5% of your PIA, and the maximum benefit at age 70 will equal only 130.5% of your PIA. We see the decrease in both early and maximum benefits for those born later than 1954 on the chart here. For those born in 1960 and later, the early benefit at age 62 will only equal 70% of the primary insurance amount, and the maximum benefit at age 70 will only be 124%. Again, these changes reflect the adjustments to the program over time. At this time, you're probably wondering when to start your benefits, and the answer depends upon several factors. Do you have other retirement income resources like a pension, savings, or a 401k? Are you married, as the death of a spouse would leave the survivor with the larger of the two benefits? This might have a negative impact if you start early. Do you intend to keep working to provide income while you wait? And lastly, do you expect to live a long life? The issue here can be how long you have to live to recover benefits you did not take if you have to wait to take those benefits until later. We use an exercise called the break-even analysis to help make that decision. There are different methods for performing break-even analysis. There's a complex and simple method to calculate the break-even, but today we're only going to use the simple version for the sake of time. Simple break-even analysis is consistent for any primary insurance amount at normal retirement age of 66. If you delay taking benefits from age 62 to age 66, then your break-even age is 77. And break-even age is extended to age 81 if a 3% annual COLA is part of the analysis. Okay, so in other words, without the COLA factor, this means that you would have to live to age 77 to recover the income you gave up between age 62 and 65 by waiting. Or if we consider the 3% projected COLA, you would have to live to age 81 to recover the income you gave up between ages 61 and 65 by waiting for the larger monthly benefit. If you delay starting benefits from age 62 to age 70, then your break-even age is 80 and 84 with the effect of the projected COLA. Finally, if you delay benefits from age 66 to age 70, then your break-even age is 81 and 86 with COLA. Other ages and waiting period are best done with a calculator tool. Keep in mind that Social Security has actually eliminated this from their website and their break-even calculator. But we can do these calculations for you. Moving right along, so what is COLA? COLA is an increase in your Social Security benefits to battle inflation. COLA adjustments are currently automatic each year based upon the increase in what is called the CPIW, the Consumer Price Index for urban wage earners and clerical workers. Annual COLA for Social Security benefits are announced every October. So when you see pumpkin decorations, a COLA increase is just around the corner. COLA increase takes effect in January of the following year. A COLA announcement in October of 2018 will go into effect January 2019. COLA increases are effective for current and future benefits. In other words, if your annual Social Security statement projects a $2,000 monthly benefit, the COLA increases along the way are applied to that benefit as well. This chart shows the history of COLA increases since 1975. And it is interesting in that it also shows the history of inflation. One question we often get is, why do we care about the history of COLA? Well, when forecasting retirement income over time, we often want to estimate the COLA that might happen with Social Security. So to do this, it is useful to look at some averages. Let's examine some averages now. Since 1975, the annual COLA increase is 3.8%. But as we saw in the chart of increases over time, these increases have been getting smaller and smaller. Over the last 10 years, the average annual increase has only been 1.84%. And over the past 5 years, the average annual increase is only 1.04% per year. Now, let's discuss spousal benefits. First and foremost, an eligible spouse may receive the larger of two benefit calculations: a benefit based upon their own earnings history, or a spousal benefit based upon the spouse's earnings history. Again, whichever is the larger benefit. What this means is that if one spouse within a married couple was a homemaker and does not have an earnings history, they will still, in most cases, receive a Social Security benefit in addition to the benefit received by their spouse. So what is an eligible spouse? To be eligible for a spousal benefit, they must be married for at least 1 full year immediately before application for benefits. The spouse must be at least age 62, and the worker spouse must have filed an application for benefits. At the spouse's age 62, the spousal benefit is equal to 35% of the worker's primary insurance amount. Remember, the primary insurance amount is the monthly benefit at normal retirement age. At the spouse's normal retirement age, the spousal benefit is equal to 50% of the worker's primary insurance amount. Okay, so as an example, we will again assume the primary insurance amount is $2,000 per month. Based upon the primary insurance amount, if the spouse opted for spousal benefits at their age 62, then the monthly benefit would be $700 per month, or 35% of $2,000. If the spouse files for benefits at their normal retirement age, then they would receive a monthly benefit of $1,000, or 50% of the working spouse's primary insurance amount. Now, keep in mind, the spousal benefit can never exceed 50% of the worker spouse's primary insurance amount at normal retirement age, even if the worker spouse waits to take the maximum benefit at age 70. In a few minutes, we'll look at a couple of spousal benefit claiming strategies. As we discussed earlier, upon the first death of a married couple who are both receiving benefits, the surviving spouse will retain only the larger of the two benefits. As stated earlier, this can impact retirement planning, so the likely first to die wants to wait to collect the largest benefit. There are spousal benefits for divorced spouses as well. A former spouse can receive a spousal benefit based upon the earnings record and primary insurance amount of their previous spouse. In this case, the former spouse that's claiming must at least be age 62 and currently unmarried, must have been married to their previous spouse for at least 10 years, divorced for at least 2 years, and they must not be eligible for an equal of higher benefit based upon their own earnings record or some other prior qualifying spouse. If a divorced spouse receives a spousal benefit based upon their previous spouse's record, it does not affect or reduce the benefits of the previous spouse or the spousal benefit for their current spouse. In order for you to receive a spousal benefit based upon your former spouse's earnings record, your ex-spouse does not have to have filed for benefits. Moving right along, let's discuss the restricted application. This applies to married couples who both have a Social Security work record and primary benefit, but they want to increase the lower of the two benefits by taking advantage of delayed retirement credits to age 70. The restricted application strategy provides Social Security income using the larger of the two spouses' primary benefit plus the spousal benefit for income, while the lesser primary benefit continues to grow. Again, this technique is used when both spouses have reached normal retirement age. Social Security income is needed or desired, and the goal is to grow the lesser primary benefit to age 70. Let's start by laying out the concept. The spouse with the larger benefit will file and claim full benefits, and that full benefit will provide income to the household. The spouse with the smaller benefit files what is called a restricted application for their spousal benefit based upon their spouse's work record, and they can do this because the spouse has filed for benefits. In this case, they are filing a claim that is restricted to their spousal benefit only, which is why it's called a restricted application. The result is that their primary benefit continues to grow by 8% per year while they are receiving a spousal benefit. And of course, when they reach age 70, they will switch to their maximum primary benefit. Okay, so moving here, we have an example. Let's put numbers to this concept. Meet Mona and Rob, both age 66, their normal retirement age. Mona has the larger primary benefit, while Rob's primary benefit is lower. And they want to grow Rob's benefit until his age 70. Mona claims her primary benefit at age 66 of $2,000 per month. Rob has the lower benefit of $1,500 per month, and they want to grow his benefit to age 70. So since Mona has filed for her benefits, then Rob can file for a spousal benefit based upon her record. So Rob files for his spousal benefit based upon Mona's work record. He restricts his application to his spousal benefit only. In this example, his spousal benefit equals 50% of Mona's primary insurance amount of $2,000. So he begins a spousal benefit of $1,000 per month. The result is that when Mona is receiving $2,000 per month, Rob is receiving $1,000 per month, while his primary benefit grows to age 70. When Rob turns 70, he will switch to his primary benefit and receive of at least $1,980 per month. During this time, both benefits might increase with COLA. Only one member of a married couple can file a restricted application for spousal benefits. Social Security will not allow both members of the marriage to file for it. There are also limitations to the restricted application, but you can contact us to see if you qualify. Next up, we got the work penalty. So what is the work penalty? The work penalty is a reduction in benefits for those who continue working while collecting benefits before their full retirement age. For purposes of Social Security, working generally means earned income in the form of wages. Certain types of income may or may not count towards what's known as the earnings test. You can reach out to us for a list of which incomes are included in this calculation. Keep in mind, the work penalty only applies for earned income prior to reaching your full retirement age. After attaining normal retirement age, there is no penalty. The work penalty is based upon what is referred to as the earnings test, which is based upon the annual exempt amount. The exempt amount is simply the maximum that can be earned each year without incurring the benefit penalty. In years prior to attaining normal retirement age, the annual exempt amount for 2017 is $16,920. The penalty for exceeding the exempt amount is $1 in benefits withheld for every $2 over the exempt amount. This exempt amount and associated penalty is more liberal in the year in which normal retirement age will be attained. In the year the normal retirement age is attained, the annual exempt amount increases to $44,880, and the benefit penalty is $1 in benefits withheld for every $3. This reduced penalty and higher exempt amount becomes effective in the year in which normal retirement age will be attained, not upon attaining normal retirement age. Keep in mind, the exempt amounts change every single year. These are the 2017 amounts we're looking at here. Let's look at an example of the earnings test. If you're paying or expect to pay a work penalty, be careful, because as the administration makes calculations based off your prior year tax return, and it can take a year or later or longer to reduce your benefits. If you collected benefits you should not have, they will stop all benefits until it's made up. A good CPA can help you complete a report of earnings to prevent this. If you're considering working while collecting benefits and would like a customized report, we can help. Now let's discuss how you can determine what your benefits might be. You have two ways to determine or estimate your Social Security benefits. You can obtain your Social Security statement, or you can use the online retirement estimator tool. Both options are only available on Social Security's website at ssa.gov. As you might know, the Social Security Administration used to mail you your annual statement every year, but they no longer do so. You can only get your statement online now. If you turn to the second page, you'll find your retirement benefits. In the first section, you'll find your estimated benefit at your normal retirement age. In this example, age 67, with the benefit estimated to be $1,554 per month. The next line estimates your maximum benefits at age 70. In this example, $1,938. And finally, below that is the estimated benefit at age 62. In this example, $1,072 per month. Note that the statement only shows the age 62, normal retirement age, and age 70 estimated benefits. It's limited for calculating any other age. Statement values are also 2 years behind your actual reported earnings, and the benefit estimates assume that the last reported income continues until you elect benefits. That is why it's called a benefit estimate. There is a better way to estimate your benefits. If you're looking for accuracy, you should use the Retirement Estimator tool at the Social Security website. This estimator tool allows you to estimate your benefits at different ages and at different levels of income. If you plan to retire at 68, you can plug that in with your current income to get a more accurate estimation. The online estimator, the online retirement estimator, is the most accurate way to estimate your benefits at any age. While the online tool is easy to use, it's too much detail for today's presentation. We do have a fully illustrated step-by-step guide to help you access your benefit statement and use the calculator tool. I can provide that to you for free upon request. There are two final and important points to make regarding benefit estimates, which are not reflected in either your annual Social Security statement or in the online retirement estimator tool. The windfall elimination provision and the government pension offset both can be unpleasant surprises. First, the windfall elimination provision can reduce but not eliminate the Social Security benefits for folks that receive pensions from federal, state, or local governments, or nonprofit entities such as school districts in which employees are not required to pay Social Security taxes. The government pension offset will also reduce Social Security benefits for a current or former spouse who is receiving a pension based upon their spouse's work for a federal, state, or local government in which employees do not pay Social Security taxes. In this case, the benefit reduction equals 2/3 of the pension amount and may eliminate completely the Social Security benefit. Both the windfall elimination provision and the government pension offset are complex enough to be beyond today's presentation. If you believe that you may be subject to either of these, then additional consultation with the Social Security Administration would be required to make a benefit estimate. Moving right along, let's talk about how benefits are generally taxed. The amount of your Social Security benefits that are subject to federal income tax is based upon what Social Security calls your combined income. Combined income is your adjusted gross income plus any non-taxable interest you received, plus 1/2 of the Social Security benefits received. Non-taxable interest is interest from, for example, municipal bonds that are typically not subject to federal income tax, but this interest does count for determining taxation of Social Security benefits. Importantly, tax-deferred interest that you have not distributed from a tax-qualified retirement account, such as an IRA or an annuity, does not count for this calculation. That is important to note. By the way, combined income is sometimes referred to as provisional income. Social Security and the IRS occasionally change the terms they use. So, your combined income determines the maximum amount of your benefits subject to federal income tax if you're married and file jointly. And your combined income is between $32,000 and $44,000, then up to 50% of your benefits are subject to tax, while combined income over $44,000 subjects up to 85% of your benefits to income tax. For individual filers, up to 50% of the benefits are subject to income tax for a combined income between $25,000 and $34,000, while combined income in excess of $34,000 subjects up to 85% of benefits to taxation. As is evident, most of us will be paying some form of income taxes on our Social Security benefits. For many, Social Security benefits are only one piece of a more complex retirement income puzzle. And although they'll be the only income source for many Americans, the majority of us have other assets that we can utilize towards our journey throughout retirement. This is an area that we specialize in, and we do so using a simple and sensible approach to retirement income planning. Okay, so picture your total retirement income needs and desires as represented by this triangle. We separate your total retirement income stream into two distinct categories of income. The first category we call foundation income. This is the income you'll need every month to maintain your basic standard of living. It's considered to be a comfortable, but not necessarily for an elaborate lifestyle. The second category of income we call discretionary income. This is the additional income that you desire in retirement for fun and family. We make this distinction for two reasons: the criticality of the income to your overall retirement security, and the appropriateness of the retirement tools used to generate the different categories of income. Your foundation income is absolutely critical to your retirement security. You must know that your foundation income is predictable, sustainable, and reliable for your lifetime, regardless of what is happening in the economy and financial markets. This is the income category that sustains your basic lifestyle. Now, with discretionary income, certainty is desirable, but it is much less critical to your retirement income security. Our process is based upon the spending you expect to need for foundation income and the spending you desire for discretionary income. It's a detailed forecast of both your needed and desired expenses in retirement. Of course, this includes inflation estimates and other factors as well. Using the information you provide, we forecast your needed and desired spending for a 25-year period, which is the average duration of a retirement. We then compare your spending needs and desires to your secure income sources, such as Social Security benefits, pensions, and other secure income sources you may have in retirement. This comparison reveals your income gaps for each year of your projected retirement timeframe. Income gaps are a very important aspect of retirement income planning because they are where you actually spend your retirement savings. For each year of retirement, your income gaps are simply the difference between what you need and what you want to spend and your secure income sources. Identifying these gaps provides you with a solid mathematical basis upon which to base your asset allocation decisions for generating your total retirement income. Our forecast will show you your projected foundation income needs, discretionary income desires, and total income goal for each year of retirement. You will also see your secure income source projection for the same period of time. Secure income sources such as Social Security benefits, pensions, and other sources such as rental property income that is not dependent upon your liquid saving assets. We then show you your total income gap projection for each year of retirement and your year-by-year foundation income gap projection. These income gap projections provide the basis for making asset allocation decisions. Our retirement income forecast also includes an income and asset projection to see how long your money will last. The retirement income forecast process helps you find the right balance for your retirement savings and also refines your Social Security benefit claiming choices by testing them in the big picture of other retirement income and savings. We have discussed many topics today and understand that you may have additional questions pertaining to your personal situation. We do offer a free consultation with a complimentary benefit analysis and retirement income forecast. Just click on the button below this live webinar that says free financial analysis and complete your information. Once submitted, one of my professional colleagues or myself will personally reach out to you. Thank you all for attending today's webinar, and we wish all of you a happy retirement.